Good day. My name is Mark Woodworth. I'm joined once again by my good friend and colleague, Jack Corgel. Jack, glad to see you again.
Hi, Mark.
It's early August as we film, again, this edition of Lodging Insights. And some of you, our viewers, may have already heard our big news in that we have a new home. Effective a few weeks ago, we are now part of CBRE, a global real estate company with a significant focus on virtually all commercial real estate property types. And we are very excited and to be with a terrific group of professionals and more to come on in future videos and so forth. Today, Jack, I thought I'd start with a question for you of the Q2 data is in. We're about halfway through updating our forecasts and the new numbers will be coming out. The second quarter demand was about 4.5% according to STR, which was a little better than we had thought. Supply chain pretty much in line with what we had expected. The overall RevPAR was up a little better than we had hoped, but average daily rates dragged a little bit. So my first question to you is, then we had some jobs news this morning and so forth. So were you surprised by the Q2 numbers? How are you feeling about the economy, and how do you think the rest of the year is going to play out?
Well, Mark, those are all the relevant questions for sure. I wasn't surprised by the demand growth number. I've believed for some time that there was this underlying strength to the U.S. economy that shows up directly in hotel demand. Again, largely from ideas we've presented in the past, that the upper end of the income spectrum tends to be more inclined to travel, occupy hotel rooms, and pay higher and higher rates. So I think that the problems that we've seen in the first quarter related to weather and some of the noise that's been in the reports on unemployment and other things have really been just periodic pieces of data that don't really represent the underlying strength of the economy. And again, the jobs reports are coming in consistently over 200,000. Inflation's under control, and GDP, we got a good solid second quarter number of 4%, even though the first quarter was tarnished by weather and other things.
So for all the indices that we tend to watch very closely, certainly the slope of the line is markedly in an upward direction.
Clearly.
And we really don't see that shifting in a meaningful way really anytime soon. I mentioned we are in the middle of updating our forecast based on Moody's Analytics current thinking and the STR Q2 actuals year-to-date data. And it's our expectation that we are once again going to be raising our FPAR expectations for this year, primarily, as you alluded to me, the demand keeps powering ahead.
And supplies under control.
And supplies very much under control. A question, and I've been on the road a lot the last 30, 45 days, and again, one of the more common questions is, why aren't rates growing at a faster clip than they are? It's good, but if we look back at history and consider the current occupancy level that's now approaching all-time highs. In fact, we think there'll actually be a new record occupancy level in 2015, breaking the record set 20 years prior, 1995. And if we look back at when occupancies are at these lofty peaks, we've typically seen average rate growth 250 basis points higher than what we're seeing now.
Yeah, up in the six.
I apologize for the long-winded question, but
I knew you were going to get to a question
eventually. So but the point being, well, if it happened back then, why isn't it happening now?
Well, first of all, those are nominal numbers.
Yeah.
We've got to look at things in real terms, and the inflation rate continues to be well below the Fed target of 2%, which it wasn't back in that period that you're referring to. So the real number isn't that far away from where it was before. But there also seems to be, from people you talk to and other other pundits that we hear discussing these matters, is that there's still a bit of a reluctance on the part of hotel management to push rates, as it's
So there's a
sometimes
little
described.
bit of fragility in the marketplace
And
still.
it may be because
Uncertainty,
you get a negative GDP number in the first quarter, and just at the time you're thinking about moving the rate, and maybe it sets in a little bit of uncertainty regarding the confidence in pushing rates. So I think a combination of those two factors is probably keeping rates a little bit more under control than occupancy would indicate.
Okay. We're, I think, getting to the end of our normal time allotment, Jack, for this. And as I mentioned, again, we're updating our forecast. Those should be released hopefully by the third week in August, and we'll be back to talk more specifically about where we're going. But as you think about, again, the most recent data, the most recent news that we received all the way through this morning's jobs report, is there anything that fundamentally changes your expectations of what we're likely to see for the balance of this year in 2015, thinking also that a lot of folks now are obviously right in the middle of budgeting season for next year and making their plans. So what do you think?
Nothing on the fundamental side of the ledger. There's always the possibility of a demand shock, a catastrophic event. We're watching very closely the geopolitical events,
Yeah.
and even the disease front that may have some impact on people's consumer confidence.
Yeah, I mean, it is early in that, but I do think back to there was the SARS epidemic, and
bird
that
flu,
and that showed up in the lodging numbers, so it has happened before. So again, we're
but not a concern at this point.
but not
so
a
let's
concern.
let's not think about it that way.
Good. Well, our summer's about half over, and we hope we've had a good one. We hope you have too. We'll be back soon with more thoughts. But again, thanks for taking time out of your day to hear our current thinking.
Yeah, thanks for watching.